Based on recent client questions, today we'd like to discuss the proposed U.S. tariffs on Canadian imports. Currently, a 25% levy on most goods and 10% on energy resources. There are two key factors that will determine the impact of these tariffs on your investments. One, which industries are being levied by how much, and two, how long the tariffs will last. As most are aware, trade between the US and Canada has been mutually beneficial and spans many decades. In 2023 alone, Canada exported $440 billion to the US, while the US exported $353 billion to Canada. So although, yes, there is a deficit, it's relatively small compared to other US trading partners such as China, Europe, and Mexico. In addition, if we remove essential US imports like oil and gas, aluminum, iron and steel, and wood articles, Canada's trade surplus turns into a deficit at $280 billion of exports versus $323 billion of US imports. Understandably, the US relies heavily on these resources. In fact, US refineries are currently set up to process Canadian heavy crude, and changing this relationship would be costly and time-consuming. Interestingly, 65% of crude imports to the US comes from Canada, 100% of US natural gas imports are from Canada, and 65% of lumber, mainly softwood, which is critical for their home building industry, a sector already facing challenges. In addition, only 34% of Canadian exports are for final consumption, while 66% are for intermediate goods, meaning Canada is an integral part of the US supply chain. Tariffs would increase input costs for American industry and ultimately their end user. This ratio is much higher than any other country. All of this mutual interdependence will play a part in how long these tariffs could be sustained, when and if they are implemented. Now, let's drill down into the impacts on the Canadian stock market and your portfolio. Short term, we should expect volatility across all markets based on solely perceptions and uncertainty. Our job is to assess which sectors and stocks face the greatest risks and monitoring their financial statements. The main sectors that could be most negatively impacted are automotive parts manufacturers, steel and aluminum industries, and forestry and paper products. These three sectors combined represent only 1% of the S&P TSX index, and our portfolios currently have no exposure to these sectors. Energy, which makes up a large 16% of the Canadian index, would certainly be impacted, even though the tariff on these products is proposed to be at a lower 10%. Our current exposure to energy in our Canadian holdings is 8%, and here it's important to reiterate the strong reliance and dependency the US has on the Canadian energy supply. The following chart shows some of the companies we do own in our Canadian equity portfolio, and we evaluated their sensitivity to the proposed tariffs. Most of our holdings are in the service sector and have factors that keep them at a lower risk. As an example, we own several providers of mission-critical software. Demand for these essential businesses and tools remains resilient. We own a large property and casualty insurance company with significant operations in Canada and Europe. Its business model is not directly impacted by tariffs on imported goods. We own a power producer whose generation and consumption occur within the same jurisdiction, making it largely insulated from international trade policies. We own a professional services consulting firm specializing in engineering, with employees in Europe, Canada, and the United States. It operates independently of tariff-related risks. We own a large, well-known grocery business with only 10% of its costs of goods coming from the United States, and they've already put a detailed mitigation plan in place should any tariffs be levied on their produce. We own a telecommunications company with nearly all of its operations in Canada. While some business equipment may be subject to tariffs, the overall impact on its operations and profitability would be minimal. Two other quick points to consider. One, the currency factor. The recent devaluation of the Canadian dollar will offset some of the tariff impact, making Canadian exports slightly more competitive. Two, the complexity added by potential retaliatory tariffs and their subsequent impacts. The key takeaway? There are a lot of unknowns, and it's impossible to predict any of the final outcomes. While markets may react in the short term, our focus remains on quality companies with strong fundamentals, resilience, and excellent and adaptable management teams who are able to navigate or even take advantage of uncertainty. Be assured, we'll continue monitoring developments and adjust accordingly. On behalf of the TWM Group, thank you for watching and see you next time.